I hate intros on YouTube videos I watch. Assuming you're like me and want to get straight into the video. Be sure to subscribe for financial related content and let's get into the video. Here are tips you can use to reduce interest rate on your mortgage. 8. Consider adjustable rate option to a fixed rate loan. A consideration home buyers can make to lower their mortgage interest rate is adjustable rate instead of fixed rate mortgages. Adjustable rate mortgages typically offer a lower rate for the first 5 or 7 years. If you have the ability to pay off your home loan very quickly, an adjustable rate mortgage may be worth considering. Be careful, though. Adjustable rate mortgages can adjust higher once this time frame has ended. For consumers who are unprepared, or in instances where a large shift has occurred in interest rates over a 5 or 7 year time frame, home buyers could see a major increase in their monthly mortgage payments. On the other hand, fixed-rate mortgages leave nothing to chance. You know what you're getting up front. This trade-off is something homeowners should consider to lower their payments. 7. Use pay-for-points option. Mortgage points are an upfront fee paid by home buyers to lower their mortgage rates. Each mortgage point is equal to 1% of the value of the loan, and paying a point typically lowers your ongoing interest rate by 0.125%. For instance, paying a point on a $500,000 loan would cost an extra $5,000, but it would reduce your interest rate by 0.125% over the life of the loan. Points can save you money if you're going to remain in your home for a long time. Reducing your mortgage rate will save you money over a 15 or 30-year time frame. 6. Refinance. If you have good credit, refinancing is a great way to lower your monthly mortgage payment. This means you pay less interest, and less money, over the life of your loan. If your credit isn't good, talk to your lender about government refinancing programs or other options that may make it possible. Homeowners looking for a lower monthly mortgage payment should strongly consider refinancing their existing mortgage. Homeowners looking to refinance should especially shop around for the best refinance rates. Be sure to use a mortgage calculator to decide whether refinancing, including refinancing fees, is really worthwhile. 5. Do not use a private mortgage insurance. If you bought your home without putting down a 20% down payment, private mortgage insurance, PMI, is likely part of your loan. PMI is a special type of insurance that protects the lender against loss if you default on your loan and can add hundreds, or even thousands, to your mortgage each year. But there's good news. There are ways to eliminate PMI if you have a conventional loan. The first step is to repay enough of your mortgage, enough to get at least 20% equity in your home. Once you do, you can ask your lender to remove PMI from your loan. It's important to note that PMI doesn't automatically come off your loan once you've reached 20% equity. You have to specifically request it. Borrowers should discuss with their lender if they have made additional principal payments or improvements that increased the value or compare if the local market value has appreciated. Another option for a conventional loan borrower is to take care of PMI by paying the cost all at once, which generally includes a one-time fee. Even though the fee may be a large amount, it may lower your mortgage interest payment. Borrowers may also pay a portion of the single premium at closing and the remainder in their monthly payment. The result is a lower PMI premium and lower monthly total housing payment. 4. Set up automatic mortgage payments. Sometimes, the simplest things can save you money. Some lenders offer a lower interest rate for customers who set up an automatic mortgage payment. Just keep in mind that, if you close your account or change banks, your original lending bank could remove the interest rate discount applied for setting up an automatic mortgage payment. 3. Have a good credit score. Whether you're taking out a conventional loan, FHA loan, VA loan, or some other type, you're likely to get a better mortgage rate if you have a higher credit score. Lenders look at your credit score as a roadmap to your guarantee of paying the loan. A high score proves you're likely to repay your loan. And a low score means you're a riskier bet. And if you are a riskier bet, it translates to higher interest charges for you. One of the first things a loan officer will check is your credit score. It may be an imperfect system, but it helps the lender get a sense of what kind of borrower you will be. To improve your credit score, first go over your credit report to see if you have any outstanding balances. Consider paying those and be sure to make your payments on time every month. Also look for and correct any errors on your credit report, as these can negatively impact your credit. While a high credit score is ideal for mortgage approval, some affordable lending programs such as the Chase Homebuyer Grant and Dreammaker Mortgage accept lower credit scores. 2. Make a larger down payment. Simply put, the more money you put down towards your mortgage, the less you will owe on the loan. If you can make a larger down payment, you could have more equity in your home from the start. Not only will you need to repay less principal, the amount you owe on a loan excluding interest, you'll also pay less interest over the life of the loan since it is calculated on the principal owed. While some loans have low down payment options, the ability to pay more can reduce mortgage rates and monthly payments. The smaller the down payment, the riskier lenders view your loan, and the higher the interest rate you may have to pay. 1. Look around for the best rate. This is one of the smartest moves you can make. It's pretty easy to compare mortgage costs online. Take some time to compare online banks against national banks and local credit unions. The lower the rate, the lower the monthly mortgage payment will be. Credit unions are an especially good place to shop around. This is because they tend to have lower fees than traditional banks, and they pass some of these savings on to their members. Credit unions may also be more willing to work with consumers who have less than stellar credit profiles.